When people hear me say that crypto could go to zero in 2026, they think it's some kind of dramatic headline or a scare tactic. But the truth is far simpler and far less emotional. Markets do not care how excited you are. They care about intrinsic value, durability, and whether the asset in your hand produces anything over time. And for decades, I've repeated one principle that has guided every correct decision I've ever made: if an asset depends purely on someone else coming along to pay you more for it, you're not investing, you're speculating. And speculation always ends the same way: suddenly, then all at once. I still remember being a young man reading about tulip mania, watching how crowds behave when they believe they've discovered a shortcut to wealth. And every cycle, whether it was the dot-com bubble, the housing bubble of 2008, or the countless penny stock frenzies, followed the same psychological pattern: first enthusiasm, then euphoria, then denial, and finally regret. And as I watched Bitcoin soar to heights that reminded me of companies with no earnings going public at insane valuations, I felt the same chill I felt in 1999 when people told me that Warren didn't get it, that the world had changed, that fundamentals were dead. But fundamentals never die, they simply wait for gravity to return. And gravity always comes. I've lived long enough to understand that every generation needs its own financial fire to learn not to touch the stove. And while blockchain technology may survive in some form, the tokens built on dreams rather than cash flows won't. Because eventually the market demands proof: real utility, real revenue, real durability. And when that moment comes, the entire house built on speculation collapses faster than anyone expects. And that's why I warn people, not because I'm against innovation, but because I've seen too many families lose everything chasing illusions. And the thing that scares me most isn't the volatility or the speculation, it's the belief that this time is different, because the moment a crowd starts believing it's smarter than history, history returns with a vengeance. When I was running Buffett Associates in the 1950s, I learned that the fastest way to go broke is to think you found a shortcut. And crypto today reminds me so much of those old stories, except magnified by the internet, by hype, by influencers who have never read a balance sheet and yet preach financial wisdom like economists. And people follow them because it's easier to believe in a miracle than in discipline. And that right there is the psychological trap, because the desire to get rich quickly will always overpower the willingness to get rich slowly. Even though the slow way is the only way that actually works. People think my warnings are about fear, but they're really about pattern recognition. Because when you live through enough financial storms, you start to hear the wind before anyone else notices the sky turning black. And right now, the wind around crypto is howling: governments tightening regulations, liquidity shrinking, retail investors exhausted, institutions quietly stepping away while still smiling for the cameras. And behind closed doors, every serious investor I know is asking the same question: what happens when confidence finally cracks? And that's the entire structure of crypto: confidence, belief, narrative. Because unlike a business with cash flow, or a farm that grows crops, or a railroad that moves freight, a token relies on the crowd's belief that it has value. And belief is the most fragile asset in the world. It evaporates the moment someone asks a question that doesn't have a real answer. I've watched people build entire identities around Bitcoin, as if challenging the asset is challenging their self-worth. And that emotional attachment is the greatest danger of all, because emotions have never been a friend of rational investing. When I bought my first shares of Geico, I didn't pray they'd go up. I studied the company, the books, the leadership, the economics. And when the price fell, I didn't panic, because I knew exactly what I owned. But ask someone in crypto what they own, and they'll give you a story, a slogan, a hope, maybe even a conspiracy theory, but rarely a logical explanation tied to real economic output. And in 2026, when liquidity gets tight, when big players race for the exit, when governments launch their own digital currencies that make private tokens unnecessary, and when a few major exchanges fall under their own weight, you're going to see the painful truth that speculation cannot survive without constant new money flowing in, and new money never stays when confidence breaks. And here's the part nobody wants to hear. Most people in the market today aren't investors at all, they're gamblers wearing the mask of investors. And every gambler eventually meets the table limit, the moment when the odds they ignored come collecting their debt. I've seen it with junk bonds, with flashy tech startups, with miracle stocks that promised a revolution. And every time the people who got hurt were the ones who believed the dream so deeply they stopped asking questions. The psychology fascinates me because it reveals something timeless. People would rather trust a myth that promises wealth than a truth that requires patience. And that's why, whenever I give these warnings, I'm not trying to control anyone's decisions. I'm trying to protect their future selves from the pain of realizing they chased an illusion while ignoring the simple, boring, reliable path that actually works. The thing people forget is that financial destruction is rarely obvious until the final moment. And in the years leading up to it, everyone always convinces themselves that the warning signs are simply fear, uncertainty, and doubt, but I've watched enough cycles to know that the biggest collapses happen at the exact moment when the crowd is most confident. Because confidence blinds you to risk and makes you interpret every red flag as a buying opportunity. And right now, crypto is full of red flags, projects raising billions without products, influencers pumping coins they secretly dump, exchanges operating like shadow banks, leverage stacked on top of leverage, and a culture that celebrates risk-taking as if it's intelligence. When in reality, the smartest people I know spend most of their time avoiding risk, not chasing it. And 2026 is shaping up to be the year when those hidden vulnerabilities finally get exposed. Not because of some catastrophic event, but because markets are cyclical and cycles always punish excess. And crypto has been built on excess from day one: excessive optimism, excessive marketing, excessive promises unsupported by revenue or real-world adoption. And if you strip away the hype, what remains is a structure built on the assumption that everyone will hold forever. But no asset class in history has ever survived on that assumption. Because when fear enters a market with no underlying fundamentals, selling happens faster than anyone can protect themselves, and liquidity vanishes before your brain even finishes the thought. And once liquidity is gone, prices don't fall in steps, they fall straight through the floor. And I'm not saying this to frighten people. I'm saying it because in my lifetime I've seen empires built on speculation collapse overnight while the people who trusted discipline, patience, and value quietly walked past the wreckage unharmed. And the sad truth is that the crypto crowd has been conditioned to believe that skepticism is ignorance, when in reality skepticism is the most valuable tool an investor can possess. And I want people to understand that markets don't reward dreams. They reward results: consistent cash flows, durable competitive advantages, strong management, real utility. And until crypto finds a way to produce those things instead of leaning on hope, narrative, and the greater fool theory, it will remain vulnerable to a collapse so sudden and so brutal that people will look back on this era the way we look back on the dot-com bubble, not as an age of innovation, but as an age of misplaced optimism and unchecked speculation that fooled millions into believing they were investors when they were really just passengers on a ship that never had a destination, What most people misunderstand about my warnings is that I'm not predicting the future. I'm describing the mechanics that have repeated throughout financial history, because human behavior hasn't changed in 100 years and won't change in the next 100 either. And when you combine leverage, blind optimism, and a belief that an asset is too big to fail, you get a powder keg that doesn't need a spark, it only needs time. And the crypto ecosystem has been built on a foundation of assumptions so fragile that the moment one cracks, the rest come down like a chain of dominoes, starting with liquidity drying up, followed by exchanges freezing withdrawals, followed by panic selling that no algorithm can stop, and finally the realization that the entire system only functioned as long as everyone pretended the risks didn't exist. I saw this exact pattern in 2008 when mortgage-backed securities were treated like invincible assets, and anyone who questioned them was mocked as old-fashioned or out of touch. And yet, when the truth surfaced, the collapse wasn't gradual, it was instantaneous. Because once trust disappears, value disappears with it. And crypto today faces a similar reckoning. Except this time, the velocity of information is faster, the leverage is deeper, and the participants are more emotionally attached, which means the psychological breaking point will be more dramatic. And people underestimate the role psychology plays in markets. Fear doesn't care how strong your conviction was yesterday. It only cares how quickly you can run for the exit. And in a digital market where billions can move in seconds, fear spreads faster than any rational thought. And that's why 2026 worries me, not because of some mystical prophecy, but because the ingredients for a systemic unraveling are already present: overconfidence from the faithful, exhaustion from retail investors who bought the top, institutional players preparing to rotate capital into safer assets as rates normalize, and governments preparing regulations that will expose just how thin the real utility of most tokens is. And when that moment arrives, people will look back and say the signs were obvious. They'll talk about the celebrity endorsements, the speculative mania, the overnight millionaires disappearing just as quickly as they appeared, the projects with no revenue valued higher than established companies with decades of results. And they'll wonder how they didn't see it coming. But the truth is, people rarely see the bubble they're inside, because the promise of easy wealth blinds even the smartest minds. And my hope, my genuine hope, is that hearing these warnings now will save someone from making the mistake that countless investors before them made: confusing popularity with value, momentum with durability, and speculation with investing. People often assume that a collapse in crypto would be the result of some catastrophic external event. But markets rarely implode because of a single disaster. They implode because thousands of small cracks go unnoticed until the structure simply can't hold itself up anymore. And when I look at crypto going into 2026, I see those cracks everywhere. I see projects with billions in market cap and no business model. I see exchanges acting like banks without being regulated like banks. I see investors who have never read a financial statement confidently telling the world they've found the future. I see leverage hidden in layers of derivatives and tokenized promises that no one can unwind once panic begins. And the part that concerns me most is that people believe decentralization will protect them, as if the absence of oversight is a strength rather than a vulnerability. In every financial collapse I've lived through, lack of transparency wasn't an advantage, it was the fuse. And when confidence evaporated, the truth always surfaced too late to protect the people who trusted the wrong ideas for too long. Crypto today is more interconnected than people realize, with liquidity shared across exchanges that are only as strong as the weakest participant. When one fails in a liquidity crunch, it pulls several others down with it. We saw this pattern with long-term capital management. We saw it in 2008, and the same movie is preparing for a sequel, except this time it's faster, digital, and global. The tragedy is that many of the people holding these assets aren't villains or speculators. They're regular workers, young professionals, and families who were convinced that crypto was a path to financial freedom. They were sold simplicity in a world that has never been simple. They were told to hodl while insiders cashed out. They were taught to dismiss risk because acknowledging risk would break the illusion. And illusions don't survive contact with reality. When liquidity tightens in 2026, and it will, the unwind will be brutal because a market built on narrative collapses the moment the narrative loses oxygen. That's why I'm not warning about crypto out of stubbornness or ego. I'm warning because history does not reward those who ignore fundamentals. It punishes them. And every signal I see today tells me that crypto is heading toward that punishment at full speed, driven not by innovation but by the belief that innovation excuses the abandonment of discipline. What people forget is that every bubble feels rational from the inside, because the rewards come early while the risks stay hidden. And that delayed feedback creates the illusion of safety. In the early days of any speculative mania, everyone who jumps in feels like a genius. Their confidence grows faster than their understanding. Their gains convince them that they're right, and the longer the market cooperates, the harder it becomes for them to imagine a world where it doesn't. That's why bubbles always attract the brightest young minds. Intelligence without humility is combustible, and crypto has become the perfect accelerant. You have algorithms promising guaranteed yield, influencers preaching financial freedom, exchanges offering leverage to people who have never experienced a real bear market, and tokens being marketed with the same energy as consumer products. When that happens, the line between investing and gambling disappears so completely that people no longer know which one they're doing. This concerns me because investing is a long-term relationship with reality, while gambling is a short-term fling with probability. One respects math, the other defies it. And when I see entire communities celebrate defiance as a virtue, I know the ending won't be pleasant. The truth is that most people in crypto are not prepared for the psychological shock of a true liquidity crisis. They think volatility has trained them, but volatility is nothing compared to systemic failure. Volatility is a roller coaster. Systemic failure is the roller coaster collapsing. When withdrawals freeze, when on-chain liquidity dries up, when markets gap down 40% in an hour, when exchanges halt trading to protect users, it won't matter how strong someone's conviction was the day before. Fear will override philosophy, and philosophy doesn't pay margin calls. In every panic I've lived through, I've seen the same transformation. People who were fearless become paralyzed. People who were certain become desperate, and people who believed they were early become painfully aware that they were actually late. This is why I keep insisting that crypto's problem isn't technology, it's psychology. Technology evolves, psychology repeats. And when 2026 forces the reckoning that has been postponed for years, the collapse won't just be financial. It will be emotional. The hardest part of losing money isn't the loss itself. It's the realization that you ignored the warnings because the dream felt better than the truth. People often assume that the danger in crypto is purely financial. But the real danger is behavioral, because once a person ties their identity to an asset, the ability to think clearly about that asset evaporates. And I've watched this pattern for decades in everything from gold to real estate to tech stocks. The moment people say this is who I am, they stop asking, is this still smart? and crypto in 2026 is going to collide headfirst with that psychological wall. Because when markets truly break, they don't just challenge your portfolio, they challenge your beliefs. I've seen it countless times. In 1999, I watched brilliant young analysts cry at their desks because the companies they swore would change the world couldn't even produce $1 of earnings. In 2008, I watched homeowners insist their property values could never fall right up until they did. And when the truth arrived, it didn't knock politely. It kicked down the door. The same will happen in crypto, not because people are foolish, but because the incentives have rewarded belief over analysis. When faith is profitable, people choose faith. And for a while, it works. But eventually, reality demands payment, and it always collects with interest. In 2026, the pressure will come from every direction at once: regulatory frameworks tightening, liquidity evaporating, institutional capital rotating out, retail holders realizing they bought narratives instead of assets, and exchanges discovering that the liquidity they promised wasn't liquidity, it was hope. And hope is a terrible counterparty in a panic. What worries me most is that people are treating this warning like noise rather than signal, dismissing it because it contradicts the dream they've invested in emotionally. But the market does not care about your dreams. It doesn't care about your community, your optimism, your slogans, or your favorite influencer. It cares about fundamentals, and fundamentals are what crypto has avoided confronting for more than a decade. When the reckoning comes, it will not be slow. It will be sharp, sudden, merciless, and entirely predictable in hindsight. And the tragedy is that the people who lose the most will be the ones who believed the most, because belief without discipline is the most expensive trait an investor can have. When people talk about the idea of crypto going to zero, they imagine some dramatic moment, a single crash, a headline so big it shakes the world, but real collapses rarely happen that way. They build quietly, accumulating pressure one unnoticed weakness at a time, until the final trigger looks obvious only in retrospect. And 2026 is shaping up to be the year when all those unnoticed weaknesses converge. What most holders don't realize is that the system they trust relies on a fragile choreography between liquidity, confidence, and timing. And if any one of those legs breaks, the entire structure falls faster than anyone can react. I've lived through enough market crises to know that the most dangerous phase is the one where everything still looks stable on the surface. Beneath that surface, institutional liquidity is already migrating towards safer yields. Regulatory clarity is forcing companies to reveal uncomfortable truths, and exchanges are quietly adjusting their risk models because they see what retail investors cannot. The flows that once fed crypto's growth are drying up. And when inflows shrink, leverage becomes lethal. People don't appreciate how much invisible leverage exists in this ecosystem: borrowed capital disguised as liquidity, synthetic exposures hidden behind derivatives, automated trading systems designed to amplify every move rather than stabilize it. When markets turn sharply, those systems won't defend prices. They'll accelerate the collapse. I saw the same mechanics in 1987 when portfolio insurance was supposed to protect investors but instead magnified selling. I saw it when banks in 2008 used models that assumed liquidity would always be available right up until it wasn't. And crypto is even more vulnerable because, unlike traditional markets, there is no central backstop, no lender of last resort, no coordinated stabilization mechanism. When the unwind begins, each participant will act in their own interest, and the system will fracture along every weak seam simultaneously. People think decentralization is a hedge against risk, but decentralization without accountability is just chaos waiting for a spark. And the spark won't be dramatic. It will be mundane, a frozen withdrawal, a failed redemption, a single major token losing its peg, a large exchange halting trades for maintenance. That's all it takes to flip belief into fear. And once fear takes the wheel, everything that seemed revolutionary will suddenly look fragile because value not grounded in fundamentals cannot withstand panic. I warn people not because I'm against innovation, but because I've seen too many investors forget that excitement is not a moat, community is not a balance sheet, and hope is not a strategy. When the dust settles, the lesson will be the same lesson every generation learns the hard way. You can't escape the laws of economics just because the technology feels new. The truth I've learned after a lifetime of watching markets rise, fall, and rise again is that the world never changes as much as people think it does. Technology evolves, culture shifts, platforms come and go. But human behavior remains the constant force that drives every boom and every collapse. And that's why my warning about crypto isn't a prediction of doom, it's a reminder of patterns that have repeated for centuries. Every bubble begins with a promise, grows with excitement, matures with arrogance, and ends with disbelief. And when the disbelief phase arrives in 2026, it will be the moment when people finally see the difference between an asset with intrinsic value and an asset powered only by crowd psychology. The painful part is that the people who lose the most will insist until the final moment that they are right, because admitting the truth would mean admitting they ignored every signal along the way: the absence of cash flows, the reliance on greater fools, the reflexive optimism, the belief that decentralization magically solved every economic problem humans have ever faced. Markets don't forgive that kind of blindness. They educate it, and their lessons are expensive. I've spent decades telling young investors that you should never bet your future on an asset you can't explain in simple terms, and you should never confuse popularity for durability. But crypto has turned those warnings into philosophy while turning speculation into culture. And culture is a powerful thing. It convinces people that being part of a group is more important than being right. When the correction comes, the noise will disappear, the slogans will vanish, and what will remain are the timeless principles that have protected investors long before digital tokens existed, by businesses with real earnings. Trust fundamentals over hype. And remember that wealth is built slowly, patiently, deliberately. If people learn that lesson in 2026, the collapse won't be the end of anything. It will be the beginning of wisdom. And as I've said my entire life, the market has a way of rewarding those who think long-term and humbling those who don't. So if you found value in this warning, if it made you think, or question, or simply pause before rushing into the next big promise, then I'd appreciate it if you'd subscribe to the channel and leave a like on this video. It helps the message reach someone who may need it before it's too late.